Alrighty, so we got a 75 basis point rate hike today. Powell made it clear the hikes will continue until morale improves. And what did that do for morale? I'll tell you what, on Wall Street, it certainly didn't improve it. We started out when Powell, before Powell was talking, the S&P was at 3,900. It was up about 50 points. Within 20 minutes of Powell's press conference kicking off, that the S&P had gone down to 3,800. It had lost 100 points and ultimately ended the day around 3,750. So ultimately, this Fed rate hike was not great for stonks. In fact, it was very bad for stonks. Why, you may ask? Well, Powell reiterated that his focus is on fighting inflation and that he's not really worried about going too far. He said, you know, if we hike too much and it causes some problems, well, we can just cut. And so that's the Fed's attitude. The Fed is going to keep hiking until something breaks seriously, and then they're going to cut rates. But until then, Powell sees no reason for cutting rates. GDP officially is up. I disputed that in the past, but as far as the official numbers are concerned, GDP is up. Jobs are still looking pretty good. The unemployment rate is not high. And so Powell doesn't really have any reason to quit hiking rates. Inflation is high, yet all of the other economic data, by the Fed standards, the way the Fed looks at this, is doing quite good. So they have every reason to continue hiking rates. The only hope was that the Fed will no longer be hiking at a rate of 75 basis points per meeting, but rather at 50 basis points. That's the expectation that was set. So they're still going to be hiking. The Fed is not cutting rates anytime soon. The Fed has hiked multiple times at 75 basis points. We have every reason to believe that they're going to hike multiple times at 50 basis points. So what are we looking at? We've got he hiked 75 points up to 4% now. Well, you add on two 50 basis point hikes, that'll put you at 5%, and after that they're going to go down to probably 25 basis points, and at least one of those will put you up at 5.25. The Fed is going to be, with the Fed funds rate, where they were way back in like 06. And so mortgage rates are going to continue to go up. The stock market is going to collapse. The housing market is going to collapse. And there's nothing that can be done about it. Because it's not like the Fed has, should just keep rates low. That's not the answer. The Fed keeping rates low is what has caused all of this mess. That, of course, and the government deficit spending, particularly in the era of the Wu flu, things like the CARES Act that were signed by Donald Trump. And frankly, the more that the federal government continues its heavy deficit spending, the less reason the Fed has to quit hiking rates. The Fed has to hike rates to counter all of this stimulus from the federal government. The federal government is just dumping money into the system by selling bonds and then spending it in the form of tax money. These bonds are bought up by banks that create money out of thin air, the primary dealer banks and whatnot. And so treasuries have a seemingly limitless demand. Or at least, there's theoretically a limit, but the federal government hasn't hit it yet. The federal government can continue to sell bonds. The only thing that will stop them is if the Fed hikes rates and makes it too expensive for the federal government to sell bonds. And frankly, maybe we'll get to that point, because I forgot to check the 10-year, but it can't be looking too good right now. It's probably right around 4%. Maybe it went up today. I don't know. It was around 4% last I checked. And so pretty much mirroring Fed funds at this point. Maybe it'll be a little above. Maybe we'll see a 50 basis point rise in treasuries. But things are still getting worse, and they're going to get a lot worse from here because the real crash hasn't begun. We are in the opening stages. This is the Fed setting the table for the massacre. Remember, um, the stock market is still well above its pre-2020 levels. I'm trying to remember where exactly the S&P was back in like January, February. I think the high was in February of 2020. I think it was like around 3,200, 3,300. It was over 3,000. Fairly certain about that. I don't think it got up to 34, but I think it was like 32, 33. I should go back and check that. We're at 3750 right now. We've got a long way to go, even to get back to February of 2020, which, at the time was an insanely overvalued stock market bubble. Market cap to GDP still matters. The value of these companies relative to the overall U.S. economy, relative to what these companies produce, it's absurd. They've got a lot of value to lose, and we've been seeing that. We've been seeing the early stages of that with the most overvalued companies, the FANG stocks, all these big tech giants like Amazon and Facebook, or now known as Meta. They have been imploding. Why? Because they're not real companies that make money. They're a part of a bubble way bigger than the dot-com bubble. And I think I'm actually accurate in saying that now. I believe if you take the total market cap to GDP, it is more inflated now than it was way back then. Although if you isolate the tech stocks, perhaps tech stocks themselves were more inflated back then. But I don't care about just tech stocks. I care about the whole market. And the collapse in asset prices is going to lead to a reverse wealth effect that will crush the American consumer, the upper middle class, the people who benefit from asset price appreciation, the upper middle class and the high class. But the high class individuals are kind of above where income influences their consumption. They don't really think about budgets, at least not when it comes to regular everyday items that they're competing with the poor's for, like a TV or something like that, or a computer. Sure, when the going gets tough, the rich buy less private jets, but they're only competing with each other for those items to begin with. And so this reverse wealth effect will help the problem of inflation. People are using the equity that they've built up through this Fed asset bubble to fund their consumption. And if that asset bubble collapses, which is explicitly the purpose of the Fed's actions here, they're trying to undo everything that they've worked to do for over a decade now, a decade and a half pretty much, because that's the only option they have for fighting inflation. Yes, oil prices are a big part of it, energy, whatnot, but the Fed does not control oil exploration. The Fed cannot print more oil. All they can do is influence asset prices and the financial system. And if the financial system is fueling inflation, which it always does, the financial system in the United States is inherently inflationary. And so the Fed is using its influence over the financial system to choke the demand side of the economy, which not only is going to counter inflation caused by an increase in the supply of money, but also the increased scarcity of goods. And so they're going to, because supply has collapsed, the Fed is going to crush demand even further to make up for the decline in the supply of goods. At least that's what Powell is saying right now. He's still maintaining that. I was very skeptical of Powell for a very long time. I still am. I'm not 100% sold. I don't think that Jerome Powell is the new Paul Volcker, but that's certainly the line that he's been trying to take. That's what he's been trying to walk, and I don't think he has the wherewithal of Paul Volcker, but he may prove me wrong. But if he is really a Volcker, the collapse that Powell will preside over will be far more spectacular than the one that Volcker oversaw. Inflation is much worse now, but the financial asset bubble is so much worse. This bubble economy was embraced fully by Alan Greenspan and nurtured and continued by his successors, Ben Bernanke, Janet Yellen, and now Jerome Powell. They all worked to prop up the bubble. And then, of course, the Phillies are in the World Series, so who can forget that? The curse of the Phillies. They always cause a financial collapse. So yeah, until we start to see the unemployment rate really shoot up, some people have theorized when we see the unemployment rate rise above the inflation rate, that's when the Fed will pivot. That's decent speculation, but I think it's pretty clear that Powell's not going to pivot anytime soon. We have not seen the surge in unemployment yet. The mass layoffs have not come. And here's the thing. In the past, the real crisis hasn't even, kicked off until the Fed starts cutting anyway. So it's not like once the Fed pivots, oh, that's when we can breathe a sigh of relief. No, things will continue to get worse from there, because the process will have already begun by then, and the unwinding will have to take place. And frankly, the Fed has less ability now to fight the collapse than they ever have, because they've blown a bigger and more disproportionate bubble than ever. The Fed already had the U.S. economy on life support going into this. And so these stormy seas are going to be enough to really upset, what balance the Fed tried to strike, in the years following the 2008 crisis. The Fed had just been trying to hold everything together with duct tape. But obviously, the structural integrity of the U.S. economy had been long since compromised. So, with that said, I will see you folks back here tomorrow.